Fed's main tool for trying to either accelerate inflation and credit or decelerate inflation and credit is interest rates. Um, and so when they raise interest rates, they can generally slow down the rate of borrowing by making borrowing less attractive. And if they want to accelerate borrowing, they can lower interest rates and therefore try to provide a boost. The problem is the federal government's not really interest rate sensitive. A lot of their things are just locked in. They're going to borrow regardless of what interest rates are. And so the Fed's tools are less effective in a fiscally dominant environment. And if it gets extreme enough, it can actually be pro cyclical in the sense that higher interest rates make federal interest expense larger and therefore increase the size of the deficits, which can be stimulating in some ways. And so it's a very different macro environment than has been the case for most of the past 40 years. We've been in fiscal dominance. Early stages was like 2018, 2019. But really, more recently, in a cyclical sense, the 2023, 2024, and still in 2025 period has been characterized by fiscal dominance.
Hey everyone, and welcome to another episode of the What the Finance podcast. On this episode, I have the pleasure of welcoming back Lyn Alden. So Lyn is a popular guest. She's one of the foremost macro strategists, currently founder of the Lyn Alden Investment Strategy, and also author of the book Broken Money: Why Our Financial System is Failing Us and How We Can Make It Better. So Lyn, thanks so much for coming back on the podcast.
Thanks for having me again. Happy to be here.
No problem. Looking forward to the conversation. I think it's been close to a year since you last spoke, and yeah, it seems like decades with everything that's been happening. But I'd really like it if you could start very broad and just outline what you're currently seeing in the economy, and I guess we can narrow it down later on.
Sure, it sounds good. I continue to view that the probably the biggest thing to focus on is U.S. fiscal deficits. I think that for years, I mean, during the whole pandemic and even after the pandemic, that has been an underappreciated topic in macro. It's increasingly understood, but I still feel like it's not fully conceptualized by a lot of market participants. Basically, the U.S. is now in fiscal dominance, which is to say a couple key things. One is that public sector deficits or public sector debt creation is now larger in most years than the sum total of private sector debt creation. So if you add up net new bank loans, net new corporate bond issuance, and even estimates of less liquid private credit deals, that whole arrangement is generally smaller in a given year than total federal deficits that year, total federal Treasury issuance. And so the reason that's relevant is because the Fed's main tool for trying to either accelerate inflation and credit or decelerate inflation and credit is interest rates. Um, and so when they raise interest rates, they can generally slow down the rate of borrowing by making borrowing less attractive. And if they want to accelerate borrowing, they can lower interest rates and therefore try to provide a boost. The problem is the federal government's not really interest rate sensitive. A lot of their things are just locked in. They're going to borrow regardless of what interest rates are. And so the Fed's tools are less effective in a fiscally dominant environment. And if it gets extreme enough, it can actually be pro cyclical in the sense that higher interest rates make federal interest expense larger and therefore increase the size of the deficits, which can be stimulating in some ways. And so it's a very different macro environment than has been the case for most of the past 40 years. We've been in fiscal dominance. Early stages was like 2018, 2019. But really, more recently, in a cyclical sense, the 2023, 2024, and still in 2025 period has been characterized by fiscal dominance.
Okay, yeah, a lot to unpack there. So, what has been the major driver of this increase in deficits? Because if we look at 2019, obviously it was I think what reasonably they're 3%, but it seems to be there's been a massive step jump, not just in the US, but basically most Western economies. So what has been the driver that you've seen, and why is it so hard to reduce it?
Yeah, there are a few main drivers. Right now, there has been an uptick around the developed world, but the U.S. is a pretty significant outlier compared to, say, European countries or other Western nations. And there's a couple main reasons for that. One is so for decades, higher public debt to GDP ratios from accumulating deficits have been offset by structurally declining interest rates. So, for example, if you double your debt level, but you cut your interest rate in half, your interest expense stays the same. And that's largely kind of directionally what happened for about 4 decades, and the Western world hit zero, in some cases negative, in the late 2010s decade. During the kind of heart of the pandemic lockdowns and the deflationary shock, the brief one, and that was basically at the top in the bond market. And now bonds, let alone higher rates, if they just go sideways now, like for example, Switzerland already managed to get their interest rates back down, but they're not really going lower than they were before. Now, we're kind of in this more sideways pattern, most likely. So you no longer have an interest rate offset to larger accumulating stock of debt, debt to GDP or debt in the absolute sense. Um, and so that's one big factor that's gone now. So that adds to the deficit. The other one is that, and countries are on different time periods for this, but the U.S. Is really hitting its demographics cliff. And so Social Security had spent decades basically accumulating. So basically, more was paid into it than was paid out. And in the late 2010s, we hit the peak there and started rolling over. And according to the Social Security Administration themselves, for the next decade or so, going into around 2035, they're going to draw down their existing $3 trillion fund and push that back into the economy as there's the whole very large baby boomer generation is retiring and will be increasingly retired and drawing from that with fewer workers to really pay into that. And so that is, pro deficits, pushing money back into the economy. And then there's other major factors. I mean, for decades, the U.S. and say NATO countries were reducing their military spending as a percentage of GDP. In the U.S.'s case, that was often basically that military spending was kind of going sideways, which when you have a rising nominal GDP would result in a decreasing military expenditure as a percentage of GDP. But because of a variety of current factors, we kind of hit the floor there, most likely. And now we're sideways to up in terms of military spending as a percentage of GDP. It's a little bit more notable in Europe because theirs got lower to begin with for many countries. But even in the U.S., when you consider multiple, kind of extra bills and stuff supporting some of what's going on, that adds to the deficit. So a bunch of different things together have kind of culminated in the 40-year period of what we've been in, the monetary dominance coming to an end.
Okay, yeah, really interesting. Do you see it's getting to the point, obviously 10-year sort of yields are at close to 5%. Sort of seen at the ceiling, but do you see a point where maybe the Fed and Treasury lose control of this, or will they find ways to sort of suppress it as well as they can?
It's quite possible they could temporarily lose control, like we saw, for example, during the 2022 gilt crisis. The UK briefly lost control and required rather awkward central bank intervention, despite the fact that inflation was very high. So like the Bank of England literally had to cancel a speech on balance sheet reduction to instead do emergency balance sheet increases to put out the fire that was happening in leveraged gilt markets. Um, the U.S. isn't in quite that vulnerable of a position, but we have occasional moments of vulnerability where sometimes the central bank has to step in. And we've already seen action by the Treasury to impact this. And so, for example, during Secretary Yellen's term, she issued a bunch of extra T bills to fund the deficit at higher ratios than is normal, and that allowed them to, one, draw from the reverse repo facility. So basically pull liquidity that was already in there, get that back out into the banking system. So it doesn't strain the treasury market. And two, it's basically a cash equivalent. A T-bill is kind of like a cash equivalent. And so, various pools of capital can hold it with less risk because you don't have to worry about the price going down substantially because of interest rate increases and all the volatility that's associated with longer term bonds. And so one thing you generally see in emerging markets, if they have trouble with like the long end of their bond market, because if say you don't want to lend to a emerging market government for 20 years, 30 years, or maybe even 10 years, they'll issue more short-term paper. And directionally, that's what we've seen from the United States. Um, and Scott Bessent, the current Treasury Secretary, originally talked about fixing that. He said we're going to lower long-term interest rates and we're going to term out the debt. So far, they've not done that, and they've specifically talked about the fact that because interest rates are higher than they expected them to be, They've blamed the Fed, but for whatever reason, the interest rates are higher than they expected them to be. They're not terming out their debt. They're continuing with the T-bill strategy. Um, in addition, they've already talked about that, when Chairman Powell's term comes up in 2026, or at least his chairmanship term, not his full term, they plan to, put someone else in there that's more of a dove. That's more willing to put lower interest rates in place. So the combination of having a Fed that is somewhat supporting, whether they say it out loud or not, somewhat supporting, the large debt load, and tweaking their term structure. So there's not a lot of demand for long-term debt. They can issue more short-term debt, even though that's kind of a bad look. It's kind of an emerging market look, but they have that tool available to them. And then during emergencies, the Fed can step in and buy some. So while there certainly can be periods of volatility and pain in the bond market, I still think they have a ton of ammo for keeping the train on the tracks for any sort of investable time horizon.
Okay, makes sense. And how, has the tariffs actually impacted, I guess, the certainty in the markets? How have you sort of been paying attention to them? And obviously, who knows what it'll be like before this interview gets uploaded? Because I think Trump was talking about tariffs on Japan and South Korea of 25% just a few minutes ago.
Yeah, right. So in April was kind of the peak tariff uncertainty period. That's when markets really had to freak out because some of these very high levels of tariffs are placed. And if you look at Trump's economic advisor, Stephen Myron, he wrote a paper in March 2024 that talked about how to kind of rebalance trade. And one of the assumptions that they had was that during the tariff negotiation process, it would strengthen the dollar, which would offset some of the tariffs and also give the U.S. more negotiating power. That hasn't played out. We've had a weaker dollar during the tariff negotiation period. Um, and overall, I think the negotiations have been more fraught than they expected. They've had to kind of back off some of the more draconian things. A lot of those are still ongoing, so we don't know where this is going to land. So far, tariff revenue has increased, but even with the increased tariff revenue, deficits are still very large. And so it's not although I wouldn't call it completely immaterial. It is certainly a smaller factor than the overall structural trends that we just talked about. So you could potentially get, 100 or 200 or maybe even 300 billion in additional revenue in a given year. You're up against like a 2 trillion annualized deficit. So around the margins, you can affect it, but that's still, it's still a background thing to deal with. It's more about whether or not a given industry is hit hard. And unfortunately, one of the ways it's played out is that, the tariffs go on companies and then some of the really big ones get exemptions. So it kind of like the middle and the smaller companies are the ones that end up getting stuck with it. That's how a lot of government programs often end up operating. So yeah, a lot of that's still ongoing. It certainly impacts industries, even if on a macro sense, it doesn't really too much affect the fiscal dominance thesis, other than around the margins. Um, there has been some delays in the current negotiation, but then there's also increased rhetoric around it. During the sell-off that occurred around April, that reduced the administration's negotiating position, but the subsequent rebound throughout late April, May, and June, and now into July. So the fact that the S&P 500 is at new highs, the fact that the bond market's less volatile than it was back then, that does give the administration more, stronger position to try another round of tough negotiations. So I wouldn't be surprised that we entered another period of turmoil here to kind of see all these different entities and where they're going to, negotiate with each other.
Yeah, it does. It does seem like the negotiations are going to go past this sort of deadline of I think it's this week. So it seems like this is going to be a continuing trend for, I imagine, the coming months, potentially probably coming years as well. Um, and it doesn't seem to have been inflationary yet. Do you think it just hasn't come through the data, or do you think there is something to? Because I think Scott Besson was talking about how it's actually potentially deflationary tariffs.
So I think it's less inflationary than many people think. I think the monetized fiscal deficits are a bigger inflationary factor than the tariffs, and that's because the tariffs don't increase the money supply. So ultimately, inflation is a money supply thing. There are other factors, but if you just have tariffs and you don't have anything that structurally increases the money supply, then generally speaking, a higher price somewhere takes prices from somewhere else. So if certain things go up in price because of tariffs, which are basically just taxes, um, then there are other things that are more discretionary that consumers or businesses could buy less of in order to keep prioritizing things that they kind of have to buy with the increased tariffs. And that could come out of other things that are measured in the consumer price basket. So, for example, if say products out of China are more expensive, and you still have to buy them just because we're pretty obviously reliant on their electronics and other things that they provide to us, especially in the for the next few years. Um, you could buy something less from elsewhere. You could buy less luxury goods from France, for example, because consumers and businesses are pressured to with the things that they're getting from China. Just as a random example. In addition, um, tariffs can come out of corporate margins and therefore can basically come out of the stock market. And so when you have inflation, there's the what people normally think of as consumer price inflation. But if you have a period of pretty significant money supply growth, but you also have high productivity, so for example, you keep energy, oil and gas flowing, no major constraints there. If you have no major restrictions in your labor force, if you have technological advancement like AI and stuff like that, then you can have pretty significant money supply growth while keeping CPI pretty contained, at least not growing as quickly as you'd expect. And what that generally means is that the spillover goes into asset prices. So the stock market, high quality real estate, gold, Bitcoin, those things will generally go up in that type of fast money supply growth, but substantial productivity period. However, if you do tariffs or other things that negatively impact corporate margins, that can potentially force the stock market to consolidate a little bit, and so you can get a little bit of an uptick in certain consumer prices, but you could get a weaker stock market, and then therefore that could negatively impact the wealth effect. You could have a little bit less around the margin spending from higher net worth individuals, which doesn't show up in kind of day to day spending, but that can show up in luxury goods. That can show up in certain types of more expensive travel. So there's the long story short of that whole kind of like rambling is that when you have something like tariffs rather than money supply growth that's fueling potential changes in prices, it's more likely to come out of somewhere else rather than just be additive in the broad sense.
Okay, really interesting. And it sounds like it maybe could potentially not raise as much tax as expected because you might get less capital gains tax because of the asset prices going down. I guess there's other offsets around the economy, especially if we go into recession. So it seems like it could sort of similar to what we see in the UK with certain wealth taxes. They sort of get offset by the reduction in other taxes.
That's another issue with the whole fiscal dominance thing in general is that people often think that if you do austerity, it can fix it. And austerity certainly helps prevent it from getting to where it is now. But once it's where it's at now, even attempts at austerity alone tend to fail. Because if you reduce the deficit one way or another, let's say you increase taxes, including tariffs or elsewhere, or you reduce spending somewhere substantially, generally speaking, that's going to impact like the stock market, and that's going to, with a lag, give you weaker capital gains taxes. And the U.S. is far more reliant on the stock market for overall tax revenue than most other Western nations. We are more financialized, is probably the term to think of. And that's for two main reasons. One is our stock market relative to GDP is quite high because it's a global stock market. There's capital from all around the world invested in our stock market more so than other countries. We have some of the biggest, most diversified markets, companies in the world. And two, um, um, there's the big factor that a larger portion of U.S. executive compensation is from stock issuance, option issuance, that sort of thing, compared to, for example, Europe. So the combination of high wealth concentration and a lot of stock-based compensation means that when you get a flat or down year or two in the stock market, that does tend to impact, high net worth paychecks pretty significantly, and therefore, with a lag, impacts tax revenue as well. So it's a very complicated Gordian knot to try to untie, which is why I don't really expect it to be untied in a investable time horizon.
Yeah, it's definitely seems like something that's more longer term. And I guess the other trend at the moment, or the other thing that's happened recently, is the big beautiful bill that's come into play. How do you see that impacting, I guess, deficit and what we're seeing? Because I think it's going to increase the deficit by a couple of trillion over the next 10 years, but it seems to be not as bad as what was previously suggested.
Right. So most independent analysis suggests it will increase the deficit nominally. Um, Secretary Bessent, the Treasury Secretary, he has argued and would argue that it'll increase GDP as well, and therefore won't necessarily lead to higher debt to GDP. Um, that part's less important because I mean stock prices are a nominal thing, and so is deficits, and so that's more of an argument whether it's good or bad. But in terms of its impact on investing, the nominal numbers tend to be pretty important. And so that's what we generally should expect is higher overall deficits. But my kind of key point is that nothing's really new here. This was kind of expected ever since the election. And so the big comparison is not what does this bill do versus the current deficits, which is around the margin some, not a ton. It's more like compared to what many investors thought. Many investors thought that, especially because of the way they market it, is that they're going to reduce deficits. So not only are they keeping deficits where they were going to be, they're adding to them. So the delta between expectations and outcomes for a lot of market participants is pretty high. Um, and so I think there's increasing realization among market participants that these deficits are not really a one administration thing. They're more structural. They're more embedded into the U.S. political system and more broadly other political systems. They're very entrenched for multiple reasons we discussed earlier. And so regardless of who's sitting in the Oval Office, these deficits are going to be high and they'll have different flavors to them. Some groups will be better off or worse off depending on who's in that seat. But the Gordian knot here is complex enough that there's not just a simple fix to sharply reduce deficits. And so I think that more and more market participants are realizing this is going to go on for many years.
And what impact do you see this, I guess, financial dominance having on the markets? Because it does seem that, more liquid, as you said, more liquidity, interest rates aren't going to have much of an impact. Less, I guess, private debt creation. Does this just mean that assets that offset this potential, you know, deficits will increase? I know you've talked about Bitcoin, gold, and other assets that sort of protect wealth.
So all else being equal, a fiscally dominant environment is a run it hot environment. So generally you get higher nominal GDP growth than you'd otherwise expect. Generally better nominally performing asset prices than you generally expect. Like as an extreme example, if you look at an emerging market recession, a lot of times their equities will go up in their local currency because their local currency is so weak. And it's a little bit different in a developed market, but when you have a developed market that's in stagflation, and it's kind of this more fiscally dominant environment rather than a private sector credit contraction, you tend to get these like emerging market characteristics in a developed market, just less extreme. And so generally speaking, prices surprise to the upside, including asset prices. Um, and if you're worried about certain risks, like we talked before about how tariffs could negatively impact U.S. corporate margins, well, that's where assets like gold and Bitcoin or certain foreign equities can be helpful. And so I generally expect that it's the next 5 years is still generally an environment where you want to own more equities or more scarce assets than you do want to own bonds or cash, with maybe a minor caveat that non-US equities are probably increasing in attractiveness here compared to US equities. But it's very industry specific, very stock specific, and very asset specific. But all else being equal, I want to own assets that are more built for a run it hot environment, which is things that are not paper.
And how long can the US run it hot? Because it seems to be, if you look at most other countries, they haven't actually, the US has been fiscally dominant for the past, as you said, probably since COVID, whereas the UK has sort of cut back quite quickly, Europe cut back quite quickly. It seems to be unique in how it's reacted and how it's continued to react.
I mean, I think the short answer is over a decade. Now, it doesn't mean there's no consequences. There already are consequences. It just means that none of those consequences are a big enough shock to force a contraction in a way that works. Because, like you talked about, even attempts at austerity can still fail when you end up reducing your tax revenue by mistake. Um, and so I think that in any sort of investable time horizon, I usually use 5 years as an investable time horizon with a little bit of an outlook to 10 years. I try not to make outlooks beyond 10 years because technology can change so much, wars can happen, companies can come and go. You can't really invest for more than a 10-year time horizon. But basically, that kind of 5 to 10 year view, um, the U.S. demographics are only going to deteriorate till then. Social Security, Medicare are going to like to become more top heavy. I don't really see political polarization going anywhere, and so I think that the deficits are going to be very large. Um, like I said before, they're going to occasionally probably have periods of mini crisis, like, oh, look at this sharp bond move, it's the end of the world, and then a month later it's fine. And one of the implications is kind of reduced central bank independence. So we like to think of our central banks as independent, but when push comes to shove, they will always protect the sovereign bond market. And and then even though they're like in the U.S., for example, the Fed chair is put in there by the president and by Congress. Um, and so once he's in there, he has a lot of discretion to operate independently. But one, he doesn't let illiquid events happen to the sovereign bond market. And two, when his term's up, he can be put in there, but switched with someone more accommodative, which comes up in 2026. So I think over time we already somewhat have a Fed that is less independent. I think that'll be continue to be the case, meaning that they can put out little fires when it happens. And so I think we're in this world of pretty high nominal and percentage of GDP deficits for 3 years, 5 years, 10 years, any sort of investable time horizon.
Okay. Do you see the US going the way of Japan? I guess maybe not. I'd imagine it would continue to grow, but maybe from a debt to GDP perspective, I imagine. Could you see it going to 200% or?
I probably not, but it's possible. The reason is so Japan. People often think that all countries are going to go the way of Japan. There are two really unique things about Japan. One, they were the first to get there at size. They're like the oldest nation on average in terms of like median age and demographics cliffs. Um, and the sheer size of their bubble in the late 80s and early 90s was massive, and therefore provided them with a massive runway for deflation. And in addition, they reached that whole period in the 2010s decade, that kind of after they got past the initial bubble, and then they're more in like their printing phase. So is really in late 2012 is when you look at the Bank of Japan's balance sheet. It went vertical basically. There was like the whole Abenomics period, starting in the late 2012. And so for about a decade, you have this kind of massive central bank balance sheet growth. But that 2010s decade was during a commodity bear market. So that was when the Chinese economy slowed down. So we had a commodity bull market during the 2000s decade. That was the emerging market boom. That was when BRICS got their acronym because that was the place you wanted to invest. That was the big commodity bull market. The 2010s, you had these really big deflationary offsets because China was a very deflationary force. With its rapid growth of manufacturing capability, and then its kind of reduction in stress in commodity markets. That whole commodity bear market was disinflationary. And so Japan had tons of leeway to do a lot of this without it being inflationary. And then two, they're a current account surplus nation. So they spent decades running trade surpluses. They built up a positive net international investment position, meaning they own more foreign assets than foreigners own of their assets. So they have a big stream of interest and dividends that flow to them every year. And a lot of that offsets currency weakness and offsets monetized fiscal deficits. The US is entering this stage with both of those things reversed. Now we're entering a more protectionist trade environment. So we no longer really have the world kind of providing a disinflationary backdrop to us. And two, um, we have a structural trade deficit, which is what the tariffs are about. All else being equal, the US situation is likely to look hotter than the Japanese situation. So instead of kind of prolonged near zero inflation and asset price, deflation the whole time, kind of offsetting all the money printing, you're more likely to get either consumer prices and or asset prices, uh, you know, keeping up with that money supply growth because it's a hotter environment. And anything that hurts productivity is more likely to make some of that show up in CPI. And anything that's really good for productivity, so keeping the energy flowing, all the gains from AI and efficiency gains there, then it's more likely to instead push that into asset prices.
Okay, makes a lot of sense. And I guess, yeah, as you're saying, the central bank is going to have a lot of different issues to what the Japanese had at that period of time. Um, and if we go to, it seems like they're already trying to be a little bit proactive in terms of what they're implementing to provide liquidity into markets. I think they were sort of suggesting is the enhancing supplementary leverage ratio, which is going to allow banks to own sort of more government debt on their balance sheets. Yeah, do you see these small things as what's going to sort of support the current deficit and the sustainability of it in the coming years?
Well, yeah, they're all additive. And so the supplementary leverage ratio that potentially allows banks to hold more treasuries than they otherwise would. If you go back and look at the World War II era, which was the last time that the developed world had this much debt to GDP, the big warehouse for it was banks. Like in the US, like something like 25% of all public debt was stuffed into the banking system. And the sheer percentage of their assets that consisted of US debt was the highest it ever was in like the 40s and then subsequently in the 50s and 60s. These kind of stuff it all into banks and the fractional reserve banking system. So a lower supplementary leverage ratio, all else being equal, lets more be stuffed into banks. Um, but then in addition, things like the standing repo facility that the Fed has increases the fungibility between cash and treasuries. And basically, banks know that if they find themselves holding too much treasuries and not enough liquidity, they have this standing facility from the central bank that they can temporarily give them their treasuries and get cash. And at the end of quarter two, which we just ended about a week ago, that facility was tapped for $11 billion for the first time in like 2 quarters, and it was the biggest usage of it in years. Now it's still kind of small in the grand scheme of things, but standing facilities like that increase fungibility between all these different types of assets, these safe collateral, and therefore extend the runway, extend the tracks for how long they can run these types of fiscally dominant environments.
Yeah, and I imagine these will be sort of options, or that they'll make it optional, make it try and provide incentives before they get to the point where they have to force banks to to do it.
Yeah, exactly. They'll make it so that if you reduce the short-term rate, it makes banks more likely to want to buy longer duration securities, so they can get a yield, basically a steeper yield curve. Um, like a lower supplementary leverage ratio slightly increases the attractiveness of holding treasury debt. And those standing repo facilities reduce the risk of being a little bit less liquid because they have that access to liquidity when they need it. And so, especially if the treasury also issues more T bills than T notes or T bonds, because then banks and other entities holding that debt have less interest rate risk, and so all that each tool is not particularly game changing, but when you add three, four, five, six different types of tools and alphabet soup programs together, the combination is pretty significant, and is it just shows the size of the tool set they have to kind of keep this going, I think, for longer than people think. And again, it doesn't mean that there's no consequences for doing it. It just means that it doesn't enter these nonlinear failure states in an investable time horizon, and therefore keeps it up. And therefore, you want to make sure that your investments are aligned, at least in my view, with the idea that these deficits are going to continue for 3, 5, and probably 10 plus years.
Yeah, and do you see them maybe extending past banks? I guess into in lots of countries they talk about pension funds. I imagine there's also the shadow banking and the private credit and all these. There's all these other institutions that have trillions of dollars invested. Do you see them sort of moving into that? Or would that be extremely difficult to implement?
Well, so financial repression techniques generally get various pools of capital to hold more treasuries. And to some extent, the banking regulations did that because they make banks and money markets kind of hold more treasuries, all else being equal. You could see that in pensions. You could see that in insurance companies, other types of large pools of capital. All else being equal, it's a little bit harder to do in the U.S. than Europe. Um, but it's something you have to monitor on a jurisdiction by jurisdiction basis. Um, and that's often combined with some degree of either light or explicit capital controls, so frictions that make it hard to move capital out of a place if they're trying to do various things to mandate like where capital has to be. So they try to reduce the attractiveness of alternatives. Um, and so yeah, it's something to consider. I mean, like Russell Napier has emphasized this a lot that as you enter a period of financial repression, um, capital controls, you generally want to look for markets that are freer to where capital wants to be. And so that can be in globally tradable assets like gold or Bitcoin. It could be in certain jurisdictions where capital wants to be. Certain entities that are less levered and therefore more likely to let interest rates and other things kind of settle where the market wants them to be. Um, so yeah, all of these things have to be considered when you look at a given jurisdiction or a given banking system and different types of environments like that.
Do you have any thoughts on where would be more, more free, or is it very hard to sort of predict that into the future?
On average, for the next, like, let's call it a 5-year time horizon, I find emerging markets pretty attractive. They're not without risk for sure. There's plenty of pockets of risk, but when you look at them as a group, you can spread out risk. And they've been in basically a 15-year cycle of underperformance. Makes sense because it's been a strong dollar environment, and they started that period overvalued. But now they're very cheap, very underowned. In many cases, they have higher real rates than the U.S., higher nominal rates and in general, pockets of Latin America, pockets of Eastern Europe, pockets of Southeast Asia. I think many of those markets are attractive. So, in addition to non-equity assets like gold or Bitcoin, some of those cash flowing emerging markets are interesting. And then there's also certain pockets, that you can find elsewhere. Like, I don't really expect too much financial repression to hit the U.S. banking system in the next 3 to 5 years. It doesn't mean that it's not going to happen, but it means I don't place a very high probability on it. So I continue to monitor it. But if that's the case, banks can generally serve as a pass-through entity where they're not the ones receiving the financial oppression, they're passing it on to their depositors. So banks can ironically do pretty well in a financially repressed environment, especially if they start the period in low valuations. So I actually think many U.S. financials and certain other financials in developed countries are pretty attractive at the current time.
Okay, that's really interesting. And what's the end game to all this? What do you how do you see it finishing?
I think the end game is major currency devaluation across the developed world, um, because when you get this high of debt to GDP ratios on the sovereign level, there's really no elsewhere to go other than default. But because the liabilities are in their own currency, the probability of defaulting nominally is exceptionally low, and so instead they tend to default in purchasing power. And whether that shows been CPI inflation or asset price inflation largely depends on productivity. If you have massive productivity gains from AI and you keep energy flowing and all that, then bonds might still buy you the same amount of kind of textiles and electronics and software and services, but they might buy you a lot less of the highest quality assets out there. On the other hand, if you have energy disruptions or AI is not as productive as many people think, then it can even buy you fewer goods and services. So I think that across the developed world, in addition to financial oppression, in addition to occasional attempts at austerity, it's pretty much going to have to come with a big currency devaluation because they've already made a lot of these errors, and there are very few ways out of it other than kind of defaulting through purchasing power. And to some extent, we've already seen that. Like in it's been the worst bond market in modern financial history. You have to go back like a century to find, in the developed world, bond performance this poor. I just don't think it's over yet. I think maybe some of the nominal losses are either over or at least the worst is behind them on any sort of say 5-year rolling basis. But in terms of purchasing power compared to the highest quality assets you can own, I think bonds and currency are going to continue to be thrown under the bus um, for sovereign deleveraging purposes.
Yeah, and I imagine that would have to come with sort of yield curve control and a limitation of the interest rates and that governments are paying.
Either explicitly or implicitly. Like if you just kind of keep short end rates lower than they should be, you make it easier for banks to buy longer end securities. You issue more debt on the short end. You take a lot of the pressure off. And then the key challenge with financial repression is, if you hold interest rates lower than they should be, it opens your currency to a speculative attack. So like let's say Turkey, for example, they went this long period where they had very high inflation, they were holding interest rates low. So if you're a global entity, you're like, well, I'll borrow Turkish lira then because they're growing the money supply so quickly, their interest rates are low. I can buy Turkish lira and I can buy almost anything scarcer than that or anything that gives me a good yield, and it's a good trade. So generally, they combine it with some degree of disincentives or outright bans on borrowing it for that purposes, but then also that also reduces the attractiveness of that market to global investors because you're like, well, if that market's gonna, run financial oppression and capital controls, why would I want to keep capital there? And the biggest countries generally have more runway for getting away with that because there's more reasons why capital wants to be there. Like, all else being equal, capital wants to be in the U.S. more than it wants to be in Turkey. So the U.S. can kind of get away with more restrictions or more incentives against like basically things that make it hard to do a speculative attack against its currency. But around the margins, it's still there. And to some extent, that's what we're seeing in like the right now the big topic in Bitcoin is like these leveraged Bitcoin companies where they just take out debt and buy Bitcoin with it, because it's like if you can take out 5-year debt at pretty low interest rates and buy a scarce asset that historically goes up, by massive percentages, that's really the same thing as like say making a like borrowing in Turkish lira and buying a better currency with it or buying gold with it. It's kind of the same play. So eventually you might see a crackdown on those types of activities in various jurisdictions, and basically attempts to reduce how much global capital players are able to arbitrage as currency. Um, but right now, a lot around the margins. A lot of this is pretty soft because it's just inherently harder to do that to the biggest markets that matter.
Yeah, okay, makes a lot of sense. Yeah, really interesting point. Yeah, bringing up, I guess, the micro strategies and the other other companies out there. Do you see a risk of there's going to be sort of a massive blow up if the prices were to drop quite quickly and the recall debt, or how do you sort of watch that?
So it's less about a quick drop and it's more about a prolonged drop. Um, and so, I mean, for example, if you use MicroStrategy as an example, which is by far the biggest and therefore the one that's the most dangerous to the market, should it have a problem, their average debt duration is currently 4.7 years, meaning that even in a bear market, this is also why they got through the past bear market with no issue. So Bitcoin can go down, and they don't get margin calls really because their debt is termed out pretty far. Um, and so it's not just a sharp. Bitcoin could get cut in half tomorrow, and it wouldn't affect MicroStrategy significantly, other than it would potentially stop how much they're doing currently, like issuing debt and equity now, but their existing stuff wouldn't really blow up because it's all been termed out. Now, if it gets cut in half and then stays there for 5 years, that's when it starts to impact these really big entities like MicroStrategy, which so far in Bitcoin's history has not happened. But there's no particular reason why it can't happen for say a 5-year stretch. It's just a desirable enough asset that it's not happened, but it could. There are other companies out there that have done like 6-month debt or other shorter debt terms. And therefore, it takes a shorter Bitcoin bear market to potentially put them in a distressed situation. Um, and now they're not as big and systemic as like MicroStrategy is, or now it's called Strategy, but they could get there. So I would not be surprised if we have this conversation some years from now, there's some semi-large entity that blew up because they didn't term their debt out appropriately. They bought too much at the top. Some combination of mismanagement meant that when the tide went out, they were swimming naked, to use the leverage term. Um, I doubt it'll be MicroStrategy. Anything's possible, but they're kind of the fortress that's doing this. And I generally suspect it would be one of these other entities that's not terming out their debt as cautiously as MicroStrategy has been.
Yeah, and do you see this being possible with other assets? So, like, I guess gold, or could it even equities or bond? I'm not too sure. Could this be done with other assets, or is it just because of the volatility in Bitcoin? It can do it.
So in theory, you can do other assets, but there's limitations. So at least in the U.S., a operating company has a limit on how much securities it can own as a percentage of its assets. So the fact that Bitcoin is not a security, like a company can't just do this with like Nvidia stock, because they hit certain thresholds where they get treated like a fund instead of an operating company, which is way less favorable. And so if they want to stay a company, an operating company, they're kind of limited with how much they can do with securities. Um, And then two, the volatility and the price appreciation matter. So the extra volatility of Bitcoin generally means that when if you borrow at 5% and buy something that goes up, by like 40% a year, that gives you a bigger delta than buying something like, say, gold, which historically does not go up as much. Um, but if someone had a conviction case why gold's going to have a very good 5-year run, they can do it with gold too. I mean, it would have worked over the past 5 years, for example, when it basically gold basically doubled. So if anyone borrowed at near zero and put gold in their balance sheet, they would have done well. Not as exponentially as something like a MicroStrategy, but they would have generally probably outperformed their peers that just stuck around in T-bills and stuff. So Bitcoin is uh, the highest octane way to do it because it's large and liquid enough that you can do it at scale, unlike basically any other cryptocurrency. It's not a security, and it's volatile and has a lot of upward potential, despite already being pretty big and liquid. So it's the preeminent way to do it, but it's not necessarily the only way to do it.
Yeah, okay, really interesting. So, Lynn, thanks so much for your time today. I really appreciate it. We sort of touched on so many parts of the economy and macro and I guess fiscal dominance and what we expect to see. But my last question is, what is one message you want people to take away from our conversation?
I think the main message is just to research fiscal dominance. Um, because it's a different environment than monetary dominance, which almost anyone who's alive today, their entire career, let's say 40 plus years, was almost all under monetary dominance, unless they were operating in emerging markets. So basically, emerging markets managers have a pretty good, I think, understanding of this type of market. And the other basically is looking at history books and understanding how this thing normally goes, which certainly makes for kind of interesting ways to get alpha if you're in an environment that is dawning on people, but that has not otherwise been common in the developed world for a while. So yeah, fiscally dominant environments run differently than monetary dominant environments. They all else being equal tend to run it hot more, and that affects like what assets you want to own.
Great message. So, thanks again for your time. If anyone wanted to find out more about what you do and where could they find you?
People can check out lyndalden.com. I have a bunch of free research available there, or they can check out Broken Money on Amazon or elsewhere where books are sold. Thank you.
Great, perfect. I'll put this below. But thanks again for your time.